Welcome back to the stock portfolio update videos. This video, I'm going to be giving a quick update on my portfolio, but I'm also going to be going through Netflix's recent share drop after they missed out on their earnings, and Coca-Cola, who recently actually beat out on their earnings. I'm going to be reading through what happened with both companies and reporting on what happened with my portfolio. Overall, Coca-Cola is a stock that I actually used to own in my portfolio, and Netflix is a stock that I've been following for a few years now. If we have a quick look at my portfolios, you can see my stake portfolio is sitting at around $70,462, and then my Vanguard portfolio is sitting around $67,000. So great times for both, means my overall stock portfolio is sitting at around $137,000. And we can get straight into looking at how things have been going. So you can see overall my portfolio stake one is up 43%, and many of my holdings are the exact same. Obviously, Amazon's quite an interesting one. AWS was actually down yesterday and there was a lot of news on that stock, but it hasn't really affected the share price too much. And then with my Vanguard portfolio, you can see I'm still just holding the same two ETFs. VLC, which tracks the largest companies in Australia, and then VGS, which is an international ETF. So we'll start off with Netflix. Netflix shares drop after streamer misses earnings estimates, citing Brazilian tax dispute, which is quite interesting. Shares of Netflix fell as the company posted a third quarter earnings miss. The streamer cited an ongoing dispute with the Brazilian tax authorities for a weaker than estimated results. Revenue for the quarter rose 17%, in line with analyst expectations, which is still quite good. Netflix said it posted its best ad sales quarter ever during the period. So if we have a look, Netflix shares were down 9% in the morning trading Wednesday, after the company reposted a third quarter earnings miss after the bell on Tuesday, citing its Brazilian tax authorities dispute that's going on. The streamer said specific expenses stemming from a 10% tax on certain payments made by Brazilian entities to operations outside the country was not previously in its forecasts, and the company decided to challenge the impact to its third quarter after it had been reasonably likely that Netflix would lose a legal challenge over whether it would be assessed the tax, the executive said. So overall, Netflix has decided to just take it on the chin. Maybe that means they'll go through a rough third quarter, as they've mentioned, but I think long term, that probably won't have the biggest effect on the company. It's not the tax that's specific to Netflix. It's not specific to streaming, the CFO says, and the company's earnings. Absent this expense, it would have exceeded our Q3 25 operating income and the operating margin forecast, and we don't expect this matter to have a material impact on the results going forward. So yeah, like I mentioned, this is just a bump in the road. Obviously, it's heavily affected the stock price, but if you're someone that's still bullish on Netflix, this might be a good time to look at it. Revenue for Netflix's third quarter rose 17%, in line with analyst expectations, boosted by membership growth, pricing adjustments, and an increased ad revenue. For the fourth quarter, Netflix expects revenues to rise 17% year over year as those trends continue, which is still really good, strong growth. So you can see its earnings per share, that missed out quite a bit, so $5.87 versus the $6.97 expected, but its revenue was right on smack bang. So Netflix reported a third quarter net income of $2.55 billion, or $5.87 per share. For the full year, Netflix just projected $45.1 billion in revenue, a 16% jump year over year, and in line with previous expectations of revenue growth between 15 and 16%. So overall, it's been a strong time for Netflix. The stock did get hit quite hard, and if we do actually have a look at the stock, you can see it's roughly around a 10% drop, just a tiny bit over, and the stock is still trading at $1,116 a share. If we look at the last month, it's down around 8%. The last 6 months, it's still up 7%, and in the last year, it's still up 46%. So when you kind of zoom out, this is just a minor blip. If you've been a Netflix investor for the past few years, you've done quite well. As you can see, even in the last 5 years, it's up 128%. So there's a YouTuber on here who I follow called Joseph Carlson, who's been quite bullish on Netflix, and he's done lots of videos on it. And he kind of has been rewarded for his confidence in the company. He ran through the bad times and the good times, and he's been able to make a lot of money off having a strong conviction position in Netflix stock. But yeah, it's done quite well in the past year, up 46%. So again, this is just a small blip in the overall grand scheme of things, but maybe a potential time for people to buy in if this is a stock that you follow or that you enjoy. The next stock I also wanted to talk about and show, I briefly mentioned I did actually hold this stock in my portfolio. So that is Coca-Cola. So Coca-Cola, there was a time when I invested in a bunch of dividend stocks as well, and Coca-Cola was a stock that I looked at. You can see it's got a dividend yield of 2.83%, which isn't too bad. But again, I kind of shifted my portfolio. I learned I no longer wanted to be a dividend investor, so I stopped investing in the likes of Coca-Cola. But you can see in the last year, it's had a very flat year. And in the last 5 years, it's only up 40%, which isn't that good when you compare it to the S&P 500. But if we have a look at its earnings, Coca-Cola topped its earnings and revenue estimates, but says demand for drinks is still soft. Coca-Cola beat Wall Street's expectations for its third quarter earnings and revenue. The beverage company also reiterated its full year forecast, and the company's unit case volume rose by 1%, a reversal from last quarter's decline. So overall, it's pretty average earnings. Coca-Cola reported quarterly earnings and revenue that topped expectations, but yeah, it keeps citing that it's still a soft market, there's not that much demand. And after a slower start, we ended the improved performance during the quarter, is what their CFO says. Shares of Coke closed up 4%. So if we look at the earnings per share, it was 82 cents versus 78 cents expected, so they beat. And then they beat on revenue also, 12.41 billion versus the 12.39. So Coke attributed third quarter net income attributable to shareholders of 3.7 billion or 86 cents. And its net sales also rose up 5%. So overall, there's still growth in the company, but that is one of the reasons why I stopped actually investing in Coca-Cola, and I kind of ended up targeting more of the high growth companies, such as the big tech companies. There's nothing wrong with Coca-Cola. I think depending on the type of investor you are, it's probably a brilliant position. But just for myself personally, I couldn't see myself keeping Coca-Cola in my portfolio at this time in my life. And if we do have a look at some of my other holdings, you can see kind of how they're kind of focused. The closest might be Costco. People might group those two companies together, but again, in my opinion, they're quite different. When you compare Coca-Cola's 40% return in the last 5 years versus Costco's 164%, that's night and day for investors. So a lot of my portfolio is geared towards high growth, and I don't really want dividends. I have to pay tax on a lot of dividends, so I don't want to do that. I'd rather just have that company reinvesting that money, because obviously if they're paying that money out, maybe there's not as much things they can reinvest and they can grow, where a lot of my companies are hopefully in that basket of they can really grow and use that cash to keep building their business. Just a broader overview of how the S&P 500 is doing. You can see in the last 5 years it's up 93%, but just in the last year alone it's around 14.5, which is still very good if you look historically. Obviously people like to use some people quote 8% per annum, some people quote all the way up to 12% per annum, but no matter what, over a long period of returns, this 14.5% is still well above average, and it's been a very good time for many investors, including myself, as I've been able to build my portfolios. Even my 2 ETFs have done all right. VLC has kind of lagged. This tracks the Australian ETF, so I do plan on selling this soon when I go for a property. So that money's kind of just sitting there at the moment, but I will be selling that position. But VGS has done a lot better. If we have a look at the actual ETF, so you can see it's done 23% year to date. It's 1 year return, which is brilliant. It distributes quarterly. All my dividends are reinvested back into the portfolio, just kind of using a snowball effect just to kind of grow my portfolio, as I don't need that cash, or I haven't needed that cash in the short term, and that's what's allowed me to continuously compound and build my portfolio. But yeah, you can see this is my biggest position across both portfolios at around $55,000 by far. And if we have a look at the price guide, you can see it's up and to the right, and it does just hold the biggest companies globally except Australia, as you can see here, 1,300 companies across 23 different countries, but it does have a heavy weighting to a lot of those American companies that I do have in VOO as well. So overall, I think it's a good position to have in my portfolio, and it gives me strong diversification. If we have a look at my portfolios, you can see this is kind of how they're weighted. My American portfolio, majority is in VOO, and then my individual stocks. And then in my Australian portfolio, it's around 83% in my broader global tracking ETF, which is VGS, and then only 17% in VLC, which again I plan to sell. But yeah, you can see over time my portfolios have been up and to the right. A lot of that has just been consistent dollar cost averaging, but now my portfolios are getting big enough to the point where majority of the momentum is through gains, but all the deposits do still help. So it's been a long journey with these portfolios to build these over 5 years. And yeah, if I do go for a property, I will have to sell some of my portfolio. But again, that's just part of building wealth. I can't continuously just accumulate assets. I will have to spend some money at some point as well. So yeah, I'm probably going to look at selling Apple stock, as I do kind of just have a little position in that. Maybe Costco as well. That's not saying these are bad companies. It's just where I can get cash. And then also VLC. So hopefully that will be able to help me boost my deposit. But yeah, if I do sell any more, I will disclaim it on this channel. In regards to my dividends, I haven't actually updated this for last month properly, and I update this at the end of the month, so none of my October dividends are in. This was a good dividend month for me, my biggest, or one of my biggest ever, as I do get my quarterly distributions from my Vanguard account, but I'll update this later. Overall, that's how the portfolios are looking. Feel free to share how yours are looking. Just wanted to give a quick update on Netflix and Coca-Cola's earnings and how my portfolio is looking. Cheers.